we're pleased to welcome now Jeremy Nelson, partner at Element Wealth. Jeremy, good to see you. Thanks for coming in.
Always good to be here.
All right, so yesterday was a big old sell-off, wall and broad there, and I think investors got a bit spooked from two big data points, I think. First was jobs, came in a little more tepid than expected on Friday. New jobs, job growth. And then yesterday, we got the manufacturing index, which is kind of just a measure of the robustness of the manufacturing industry sector in this country. And it came in, it wasn't all that bad, but just came in a little below expectations. Bottom line is, I think investors kind of looking for the economy to really hit the skids in the near term, and that's caused a sell-off.
Yeah, so I think that what investors have to realize is the market has come a long way, and typically the market is going to get a little bit ahead of itself in forecasting where things are going. And you've got to this point where, things are really priced for perfection, and you're starting to see the unemployment rate, right? It's kind of stealthily ticked up to 4.3%.
Before you go, explain to our audience what you mean by price to perfection.
Well, so the market is a forward-looking discounting mechanism, right? It's trying to figure out what the value of the future earnings of all these companies are going to be. And so when the market valuations really start to grow, that means that any disappointment in economic data or earnings is going to kind of send things into a sell-off, right? Because right now, if you look at where market valuations are, on a historic basis, compared to where interest rates are, the market's expensive. Right? Now, it's expensive because the market is expecting things to be good into the future. So if you start to get a little bit of soft data, you're going to get some of these pullbacks. We had that pullback in August, right? About 10% correction or so. And then it kind of bounced back, right? The buy the dip people came in and bought everything back up. But you started to see some of the major leaders, the NVIDIAs, they didn't quite get to their all-time highs. And, some of the other big tech companies haven't gotten all the way back to where they were. And then, you get a little bit of soft data, spooks people. The reality is we're also going into this election cycle. People are concerned about it. There's a lot of talk about, is a recession inevitable? And so anytime you get an environment like that, it's kind of normal to see that quick little sell-off.
Yeah.
But look at where we were at the beginning of the year. Look at where we were at the beginning of 2023. The market's come a long ways. Corrections are normal. I wouldn't be surprised to see a 10% correction here.
Yeah. That's what many analysts are predicting, but there are others who think that by the end of the year, we're sort of back where we were when we were at the highs not so long ago.
Well, we're pretty much there right now. We're really not that far off the highs. We're only a couple percent off, and that's what, if the market's up 15, 18% on the year, that's double the average return, historically speaking, right? And so, things don't go up in a linear fashion, right? And I kind of like the old expression, I don't know who coined it, but markets take the escalator up and the elevator down.
That's good. That's about right. Well, that's kind of what we saw yesterday for sure. Rebounding a bit today.
Yeah,
but
and that's kind of a good sign, right? Because so we had the Nasdaq specifically get hit. We see the numbers on the Dow, and you see 600 points, and that seems like so much. Well, on a percentage basis, it's actually a pretty normal move. It's just
1.5%.
Yeah, it's just the index level is so high now that the numbers are big, and those of us that have been investing for a long time remember when 200 points was a big move in the Dow.
Yeah. When it was at 20,000. Yeah, no doubt about it. So, that's kind of where we are, and I think there's still a lot of anticipation of what the Fed may do later on this month. I think pretty much baked in is at least 25 basis points. Huh?
I think it's baked in that they're going to cut. The question is that actually bullish?
Yeah, I agree.
And I think that there's some historic precedent that would say, well, maybe it's not as bullish as people are expecting, because in a lot of cases, the Fed's cutting because they're behind the curve and they're starting to see, economic weakness. Obviously, the inflation picture has gotten better. We're still not down to that 2% target, but it's gotten better enough. Not proper English there, but it's improved enough so that the Fed is comfortable starting to cut. The question is, do they do 25? Do they do 50? I think that the more aggressive they are on the cuts, the more I would be worried. So kind of a contrarian view there would be, why do they feel like they have to cut so rapidly, so fast, when they really probably could have started cutting a long time ago? The market was expecting 6 rate cuts this year at the beginning of the year.
Yeah. Well, we've talked about this before. It seems like we've gotten into Fed watching mode in terms of investing. A lot seems to be riding on that. Maybe that's because for so long the Fed didn't do anything. And now they've kind of become, the last 3 years at least, active.
Well, I think that ever since the financial crisis, we have just become so inundated with every word in the Fed minutes, everything that Jerome Powell says or Janet Yellen said or Ben Bernanke said. And we're kind of getting away from fundamentals. We're just trading on what the Fed's going to do. Well, yes, they've got a lot of control. They set monetary policy, but ultimately they're not the czar of the economy, right? They're not the czar of corporate profits. And so I just think that the market as a whole has gotten too caught up in the Fed, not focused enough on underlying fundamentals.
Yeah. Earnings have still not been too bad, and the outlook is still decent.
Earnings have been good. I saw something about Dick's had great earnings, and there's a lot of companies that are coming out with decent earnings. I think that what you're seeing, though, is a more cautious outlook going forward.
Yeah.
I think all of these CEOs and CFOs are kind of hedging their words and hedging their bets a little bit right now because they're concerned that there could be a little weakness here as we go into next year.
Little uncertainty. Is it HP we're getting report on today, I think?
I think they
are,
yeah.
So, yeah. So, and a lot of eyes will be focused on that, especially their PC and server sales.
Yeah.
See how they did there.
I mean, obviously, this is not a solicitation to buy or sell any securities. All the disclosures, NVIDIA had incredible earnings.
Yeah.
I mean, we saw 122% year-over-year growth, 15% quarter-over-quarter growth, $30 billion in revenue, a pretty incredible story, and the stock sold off.
Yeah.
Right. And so that tells you that people's expectations are really, really high. So if you have big bellwether companies that are posting insane numbers and selling off, that means that, the market might be a little bit tired here.
Well, when you got a multiple of, 53 or something crazy like that?
Well, I really pay attention to the price to sales ratio on a lot of fast-growing companies. I think that's something that I really like to pay attention to. And you're seeing it improving, but, it's still expensive. That they have to continue to deliver growth to justify these multiples.
Yeah. That's right, because it's kind of baked into the expectation, and I think a lot of people would say, well, that's why we invest there, because we get this upward trajectory, this linear growth, as you alluded to.
Yeah, and I think that some average retail investors struggle with this a little bit. I had a client that called me and said, I want to put my money in something safe, and they were talking about NVIDIA. I was like, well, that's not necessarily safe. This was when it was at like 135, and I was like, well, it's safe because it just keeps going up. I'm like, yeah, but it doesn't go up forever. And, here we are now around 106 or so.
So what do you make of the big banks that operate credit card divisions plowing away more for reserves, concerned about the debt getting out of control, consumer credit card debt getting out of control?
Ultimately, we saw this in the financial crisis. The banks really put back a lot of loan loss reserves. So essentially what they're saying is, we're going to make a provision on our income statement that for future losses. We're going to kind of take them today. Yeah. And it's a common practice.
Yeah.
They'll probably overdo it, and then they'll they'll kind of put them back into earnings later on.
Conservative, being conservative.
I think they're making enough money elsewhere that they can kind of take these losses. And there will be some, absolutely, though.
I think Citi, if I'm not mistaken, and B of A almost doubled their reserves here recently.
Yeah.
Like a couple of billion.
The credit card debt is becoming a problem.
Okay.
There is some weakness in the consumer.
We got a break right here. If you could hang around, I want to get your thoughts on the commercial real estate market and a lot of that debt terming out next year and what that might mean.
Yeah.
We're coming right back with Jeremy Nelson, partner at Element Wealth. We are in the Element Wealth studios. Jeremy Nelson, partner at Element Wealth. So there was so much doom and gloom about the possible just collapse of the commercial real estate industry because employers were sending all their folks home during the COVID era, and all of a sudden it's given rise to this new work from home phenomenon. Now, most companies have adopted a hybrid approach. You spend some of your time in the office and some you're able to work at home. But nonetheless, they've also figured out ways to really consolidate their real estate and their office footprint. So we're seeing empty buildings. We're seeing the price of these properties decrease, but we still got debt. It's based on an old valuation of that property. Much of that debt is scheduled to term out in the next year or so. How's that going to affect the commercial banking world, and how would that affect the average person?
Well, so a lot of this debt is securitized, right? Which means it's sold off, right? So if you think about, for our listeners, you have a mortgage, right? You go and they originate it, but the bank doesn't typically keep it, right? It gets sold off and packaged into residential mortgage-backed securities.
Yep.
A lot of this debt is in commercial mortgage-backed securities.
Okay.
That market is already very depressed. I mean, you're buying a lot of this debt at pennies on the dollar. So I would argue that a lot of this is priced in. This isn't really a new story. Now, this is one of the important reasons why the Fed does need to get off and cut interest rates, because we are seeing right now that whether it's residential mortgages or commercial mortgages, rates are way up, right? So, and I like to kind of break it down to things that make sense to us as individuals. If you have a home equity line of credit today, you're probably at like 8.5%, because that's where prime is. Right? I mean, it's way up, whereas we used to get 4% or 4.5%, right? And so the Fed needs to come down to ease that burden on the prime rate, and then also ease the burden on some of these, commercial mortgage-backed securities. One point that I want to make about real estate, though. So when we talk about, commercial real estate, intuitively we go to office buildings, but there's so much more, right? So we're pretty large investors in a fund that is commercial real estate, but it's not office. Office is only like 3% of the portfolio. Multifamily housing, right? Hotels, storage centers, data centers, distribution centers for e-commerce. So I would argue that the real estate issue is largely isolated towards office buildings.
Okay.
And also retail. I mean, look, just around the corner from here, I just saw another store going out of business just in off of Ridgewood Road there. So I think that retail and office, yes, absolute stress there. But broadly commercial real estate, there are still a lot of areas of strength, like data centers, distribution centers for e-commerce and others. Yeah.
Okay, well, that makes sense. And, of course, do we have the risk that we had that was such a big factor in the meltdown in 2008 with these derivatives on some of these securities? We don't have any more.
Not even close.
Okay.
Not even close.
Explain that to our audience, what that means there.
So back in the financial crisis, people started betting against these mortgages. So through what's called credit default swaps, CDS, right? And, one of the biggest issuers of them was AIG, who had to get bailed out. The CDS market is appropriately priced today compared to back then, and you just don't have near the amount of derivatives trading on commercial mortgage-backed securities as you did on, what was going on back in 2006, 2007 that ultimately blew up in 2008 in the residential market.
Well, the problem is when they were packaging these securities up, you had a hard time identifying the actual loan and assets tied to them, right?
Well, that's it. Well, they also, in 2007, there were securities that were derivatives of derivatives.
Right.
Like, it wasn't even, they were betting on the betting.
Like, sometimes you'd have a security that was just the interest portion, right?
Yeah.
And then another would have the principal portion or part of the principal.
Yeah,
crazy stuff like that.
It was all carved up, and if you ever get to see a schematic of it, it's pretty incredible. When I was in grad school, we did a case on Abacus, which was one of Goldman Sachs' deals, and it was just so convoluted, it was unbelievable.
And then the credit default swaps essentially is insurance against default on debt.
That's
right?
what it is. You win,
right?
right? So if anyone's ever seen the movie The Big Short, it's a great movie, but it gets into that and explains how these people were actually betting against these mortgages. So they're buying insurance on mortgages that they didn't have, and then when the mortgages went bust, they got paid.
Oh, man, what a crazy deal that was. Lehman Brothers, who could forget it?
Yeah.
First to announce, right?
Yeah. I still remember. And that was the big collapse, right? That was Bear Stearns went down in March, and J.P. Morgan had to step in and take over for them. And when Lehman went down, I think, what was it, September 17th, I think?
Yeah.
Boom.
Panic.
That was the end of it.
Appreciate you coming in, Jeremy.
All right.
Enjoyed it.
Thanks, Gerard.
Jeremy Nelson, partner at Element Wealth, has been our guest. We're stepping aside for Fox News.